Welcome to this video on investing in stocks as a passive income source. If you're looking for ways to generate income without actively working for it, investing in stocks may be worth considering. However, it's important to understand that investing carries inherent risks, and it's always a good idea to do your own research, consult with a financial advisor, and understand the risks involved before making any investment decisions. Now, let's take a closer look at how investing in stocks can be a passive income source. One way to generate passive income from stocks is through dividends. Dividends are payments made by a company to its shareholders, typically in the form of cash or additional shares of stock. Many companies, especially established blue-chip firms, have a history of paying dividends to their shareholders. By investing in these types of companies, you can potentially receive regular payments in the form of dividends. Dividends can be paid on a quarterly, semi-annual, or annual basis, depending on the company. Some companies pay dividends in the form of cash, while others may pay dividends in the form of additional shares of stock, known as stock dividends. Some investors choose to reinvest their dividends, which can potentially compound their returns over time. Another way to generate passive income from stocks is through capital gains. Capital gains refer to the increase in the value of an investment over time. If you buy stocks at a lower price and sell them at a higher price, you can earn a profit, known as a capital gain. While the stock market can be volatile in the short term, over the long term, it has historically trended upwards, providing opportunities for capital gains. Investing in stocks can also be a passive income source through the use of investment vehicles like mutual funds or exchange-traded funds. These types of investments allow you to diversify your portfolio by investing in a basket of stocks rather than individual stocks. This can potentially reduce risk and increase the potential for passive income. Mutual funds are managed by professional fund managers who invest in a diversified portfolio of stocks, bonds, and other securities. Investors can buy shares in a mutual fund, and the fund manager takes care of the underlying investments on their behalf. Mutual funds can be a good option for investors who want professional management and diversification, but they may also come with higher fees compared to other investment options. Exchange-traded funds are similar to mutual funds in that they allow investors to buy shares in a diversified portfolio of stocks, bonds, and other securities. However, unlike mutual funds, ETFs are traded on a stock exchange and can be bought and sold throughout the day. ETFs may offer lower fees compared to mutual funds, making them a more cost-effective investment option for some investors. One way to approach investing in stocks as a passive income source is through dollar-cost averaging. This means investing a fixed amount of money at regular intervals, rather than trying to time the market. This can potentially smooth out the ups and downs of the stock market and help you achieve your long-term investment goals. For example, let's say you want to invest $100 per month in the stock market. Instead of trying to predict the best time to invest, you can simply invest $100 at the same time each month, regardless of the market conditions. This can potentially help you buy more shares when the market is down and fewer shares when the market is up, potentially increasing your overall returns over the long term. It's worth noting that investing in stocks is not a guaranteed way to generate passive income. The stock market can fluctuate, and there is always the possibility of losing money. However, if you do your research, diversify your portfolio, and have a long-term investment horizon, investing in stocks can be a way to potentially generate passive income. One way to reduce the risk of investing in stocks is to diversify your portfolio. This means investing in a variety of stocks across different industries and sectors, rather than putting all your eggs in one basket. Diversification can potentially help reduce the impact of any one investment on your overall portfolio, helping to reduce risk. It's also important to have a long-term investment horizon when investing in stocks. While the stock market can be volatile in the short term, over the long term, it has historically trended upwards. By investing for the long term, you can potentially ride out the ups and downs of the market and increase your chances of generating passive income through dividends and capital gains. It's always a good idea to do your own research and consult with a financial advisor before making any investment decisions. There are many different factors to consider when investing in stocks, such as the company's financial health, management, and industry trends. By doing your due diligence, you can potentially increase your chances of success and generate passive income from your stock investments. Thank you for watching this video on investing in stocks as a passive income source. If you have any questions or comments, please leave them in the comments section below.